All right. Well, hello and good afternoon, everybody. Starting to see attendees filter in for today's latest TMC Connect discussion. Tom Glucci here with the Mortgage Collaborative. Joining us now a minute after 2 p.m. for those joining us on the East Coast, here after 11 a.m. for those on the West Coast. So I want to thank everybody for joining in for today's TMC Connect web broadcast entitled Freddie Mac, Market and Industry Insights for Q1 of 2021. And for those joining today that didn't get a chance to join us live, this is actually the second part of a three-part webinar series that co-hosting with our friends at Freddie Mac. And I'll be dropping in the chat as we get started here, just an on-demand link to be able to access our past session, which focused on closing cycle time benchmark study that Freddie Mac recently did, and some really compelling findings from that. So I'll drop that information in there to be able to view at your leisure. You can do so for the audio version via our TMC Connect podcast. And I'll also have our YouTube channel link in there so you can see the presentation deck visual as well. A quick reminder too, registration is open for the upcoming third part of the series, and I'll make sure I drop that information for our attendees in the chat as well. And that's titled Deconstructing a Generation, with the focus being on millennials. So you'll see some compelling stats too as part of this presentation today on the growing millennial population into the new homebuyer marketplace. So be sure to pencil that into your calendars. That's going to be coming up on Wednesday, May the 12th at 2 p.m. Eastern and 11 a.m. Pacific for our folks on the West Coast. So just real quick, ground rules for today's discussion. Just want to remind our attendees, whether you've dialed in or you're connected via your computer, all lines have been muted for the call, done only to avoid any background noise in your area, and just make sure everybody can hear today's presentation clearly. That said, we want these discussions to be as interactive as possible, so highly encourage you. Any questions, comments that you have based on the content and some of the really intriguing metrics and information that our subject matter experts here at Freddie Mac have to share, feel free to drop those in either the Q&A box or the chat box on your Zoom screen. I'll see those on my end, and I'll be able to verbalize those on your behalf. What I will say is a quick caveat there. We will look to keep these questions towards the end of the discussion, just because there is a highly likely nature as far as the flow of this discussion that we end up answering some of the questions that you may have in upcoming portions of the presentation today. But we'll make sure we've got plenty of time to go through any questions that they have over the course of today's call. And also, today's call is being recorded, will be available for playback. We will send everybody who registered and attended today's discussion a follow-up email likely tomorrow that'll have information to receive a recording of today's discussion, as well as a copy of the presentation deck in a PDF format for everybody. So on that note, let's go ahead and dive right in. I want to introduce our esteemed discussion leaders joining us from Freddie Mac today. First off, we've got KT Thomas, Senior Director of Market Research and Marketing Analytics. Also have Yana Davidovich, who is the Director of Market Research and Insights. They both joined us for the first part of our series. And our new addition in today would be Rama Yanamandra, the Macro Housing Economics Senior with the Office of Economic and Housing Research at Freddie Mac. So KT, Yana, Rama, appreciate all three of you joining us to lead today's discussion, and excited for the knowledge that you are about to impart on our members. So I guess I will kick it over to you to be able to kick things off for today.
Yeah, thanks very much, and really a pleasure for us to be here, and thank you for inviting us. I'll kind of quickly kick it off by letting you know that the reason why we are sharing this with you is because very often we hear from our clients around the need to learn more about what's going on in the market and industry, and we're listening, and our hope is that with all the data and resources that we have from both my team in single family and also from our Office of Economic and Housing Research, we can bring you these insights so that we can all work better to stay ahead of the curve as it comes to what's going on in the market and industry. So we have so much to cover today, and I'll hand it off to Yana, who is on my market research side of the arm of the team. And she's going to go through a lot of the details today. So again, thanks for joining us. And I'll also join towards the end to answer any questions you may have. Go ahead, Yana.
Thanks, Kitty. Can you hear me?
Yep.
Great. Hello, everyone. There is a lot we're hoping to cover in the next 45 minutes. We will discuss the COVID trends, vaccine distribution, overall recovery path, and spend a few minutes talking about new consumer and housing patterns. We'll definitely delve into macro and housing market updates and cover housing demand and supply factors. Furthermore, we will address the latest forbearance trends, a topic that gets quite a lot of attention these days. So let's get started with COVID-19 stimulus and recovery section. I want to start with the snapshot of COVID cases across the regions. Our team has been tracking COVID cases trends since the beginning of the pandemic. We are seeing very positive developments as of recently. The number of cases had subsided significantly across the United States. Take a look at the two maps on the slide. The map on the left shows infection risk levels back in December, whereas the map on the right captures the infection level as of this Monday. What a striking difference 4 months make. There's a couple of hotspots, of course, that we could see across the regions, but in overall, the picture is much more promising than the one we observed back in December. Next slide. I'm sure you have heard this previously, but it is important to understand the fact that the path of the virus will determine the course of the US economy. So long as the spread of the disease in the US continued to be fueled by high level of community transmission, any prospect of a stable economic recovery will be challenging. As such, let's take a closer look at where we are in terms of COVID trends and vaccination. So far, we have seen 3 waves of the pandemic. The third one was the most severe. But as I noted in the prior slide, the rates of infections is slowing and reaching levels we have not seen since October of last year, as precautions are taken more seriously and vaccinations are in full swing. Speaking of vaccinations, according to CDC, 122 million people have received at least 1 dose of vaccine as of recently. That 122 million people roughly translate to about 37% of population that is given at least 1 dose. However, risks do remain as more people traveling over spring break. Combine that with the presence of more transmittable virus variants, we are seeing a slight pickup in COVID cases in the past several weeks. Moving on to next slide. Now, I do want to spend a minute talking about factors that are driving current recovery. Let's start with the monetary and fiscal policy support. The big difference between the current recovery and the Great Recession is how swift and aggressive the actions from both fiscal and monetary sides were, how it kept the economy afloat. There's no doubt that the first round of stimulus staved off the depression. Thus far, we have seen 3 rounds of stimulus that in total equate to about $5 trillion, which represents about 25% of US GDP. These infusions acted both stimulators and preservers. What do I mean by that? The result of the support that we have seen from both monetary and fiscal policy, we have seen stabilized financial markets, stock market rally, record low interest rates driving record housing activity, support for commercial and small businesses, record low savings rate, child care support, and let's not forget support for struggling homeowners and renters. As Rama will cover in more detail later in the presentation, we are seeing economy recovering and coming back to life. But as a nation reopening and gains the steam, some experts are worried the economy will overheat and drive inflation levels upward. Next. Another important factor that we think will certainly drive the recovery is vaccination, of course. Some experts have estimated that 70 to 90% of population needs to acquire resistance to the coronavirus to reach herd immunity. That is when transmission of the virus substantially slows because enough people have been protected through infection or vaccination. A number of factors will determine how quickly this threshold is met, of course. If the country maintains its current pace, if you go back one slide, thanks. If the country maintains its current pace of vaccination, about half of the total population will be at least partially vaccinated around mid-May, and nearly all around late July, as you can see a chart on the right. Assuming supply exists and vaccines are eventually available to children. Next slide. Continue our conversation on recovery. Here's one way Moody's is tracking recovery status. Moody's Analytics created a back to normal index comprised of 37 national and 7 state level indicators. This index ranges from 0, representing no economic activity, to 100%, representing the economy returning to its pre-pandemic levels in March of 2020. According to the latest reading, economy today operates at 86% of its level that it was before the pandemic. What caught my attention is that many southern and western states have already reached 100% back to normal levels. Let's move on to the next section. Let's start with migration and new housing trends. United Van Line's 2020 National Migration Study shows that Americans continue to move westbound and southbound, and the COVID-19 pandemic fast-tracked many of those decisions to move. The study shows that Idaho is the state with the highest percentage of inbound migration for the second consecutive year. Top in the list of outbound location was New Jersey, which has held the spot for the third consecutive year. Among the top inbound states were South Carolina, Oregon, South Dakota, and Arizona, while New York, Illinois, Connecticut, and California were among the states experiencing the largest exodus. Moving on to the next stage. Yet another interesting trend we would like to bring to your attention is urban migration. We are really experiencing urban exodus. According to a study completed by Federal Reserve Bank of Cleveland, the migration flows were definitely unfavorable for urban neighborhoods during 2020. As seen on the left-hand side chart, however, the word exodus emphasizes that migrants are leaving a particular area in large numbers. If you look closely at the chart on the right, what you see is that decline of in-migration are greater than the increase in out-migration. Out-migration did increase slightly in many urban neighborhoods, but the magnitude probably would not fit most definition of an exodus. What is certain is that many people who would move into urban neighborhood in a typical year were unwilling or unable to do so in 2020. Letting us believe that this particular trend will revert as pandemic worries subside. Moving on to next slide. Continue to our story of the urban and suburban migration. One of the new trends that we see in the housing industry is that as a result of the COVID-related social distancing and remote work, is buyers moving to lower density areas for more affordability and higher level of comfort. We will see how long this trend will continue, but for now, we are certainly seeing an elevated share of movers to more suburban and rural areas. Moving on. And the last interesting finding before we move on to macro and housing trends is diminishing affordability. We have been getting questions about whether accelerating home prices and eroded affordability. And until recently, the answer was that declining rates made home purchasing more affordable than a year or two ago. That is no longer the case. With both prices and rates growing, affordability is certainly on decline. In our example on the slide, what you see is year-over-year down payment amount were up 13%, whereas average monthly payment increased by 4%. Add to that is increasing property taxes. Affordability is certainly a concern these days. Now, I do want to turn the baton to Rama, one of our senior economists in the Economic and Housing Research Team, who will cover macro and housing trends.
Thanks, Yana. So I'm going to be talking about the economy and the housing markets. And as Yana mentioned, the outlook for the economy is improving. Economic growth, which had stalled towards the end of last year, seems to be picking up now with the ramp up in the vaccine distribution, as well as the additional stimulus that was given out. Most of very dismal levels they were at last year. The average forecast for Q1 is at 5.5%, as you can see here, the chart on the right, and you can see the range of estimates for various institutions and economists ranging from around 4% to 8%. Moving on to the next slide. Yeah, so when we talk about the additional stimulus, the question that comes to mind is, how much is the stimulus actually contributing to the GDP growth, right? So that's what I have here. So GDP is now projected to be higher than even the Feb 2021 CBO forecast that they had because of this new Biden package, because of the new stimulus that was given out in March. As you can see here, the green line is for the GDP forecast with the new Biden package. And this package, this stimulus that's given out is expected to push up growth, especially towards the end of this year. And estimates actually suggest that growth could be as high as 10% annualized rate before it starts to taper off towards the end of next year. Next slide, please. So the stimulus did lead to higher incomes, as you can see here in the dark blue dotted line here, that both in April of last year when the first round of stimulus was given out, as well as in January of this year when the second round of stimulus was given out. So, and without the stimulus, without the transfer incomes would actually have been much lower, which is the light blue line here. That's the income without the transfer income, without the government transfers. But what we noticed is that despite the increase in incomes, consumption expenditures actually did not increase much. That's the third solid blue line here. So consumption expenditures have not increased much. What's happening? What we see is that the savings rate has been rising. So in fact, in April of last year, when the first round of stimulus was given out, savings rate hit an all-time high of 33%. And even in January of this year, savings were at 20%. So what we do here in this chart on the right is we estimate how much higher are savings now because of this stimulus. What we do is we look at the pre-pandemic trend of saving and we look at the actual savings now. What we find is that savings are now 1.9 trillion higher than where they would have been if the pre-pandemic trend of saving had continued. So instead of consumption, it's actually the savings that's been going up. Now, moving on to the next slide. So now there's this concern with all the additional stimulus, all these savings, with the economy's reopening and conditions returning to normalcy, that it's going to lead to an increase in demand for goods, and that's going to push up inflation. So that's the biggest concern right now. And that's also reflected in the higher inflation expectations. As you can see here, the light blue line is for the inflation expectations, and they are actually at levels not seen since 2014. However, what's happening is that we are not seeing inflation in the data yet. And in fact, after the previous financial crisis, after the 2008 crisis, even though inflation expectations rose, it actually never materialized into higher inflation. And there are various factors which have prevented inflation from picking up. One is the shared economy. You can talk of automation, offshoring. All of these factors have prevented inflation from really picking up quite a lot. And in fact, the average inflation rate over the last 25 years has been less than 2%. And that's remained well below the Fed target of 2%. So while there will be a slight increase in prices because of what's known as base effect, and we in fact saw that just yesterday, the CPI data came out and the year-over-year growth was 2.6%. But that's because of what's known as the base effect. Base effect is because last year prices were really, really low. Last March, when the pandemic hit, prices were really low. So when you compare to those low levels, it appears that prices have increased a lot. But in fact, almost 1% of the increase is just because of these base effects. It was so low last year. And we can expect that to continue through May of this year, because until May of last year, prices were really, really low. So the year-over-year comparisons would be slightly distorted. But having said that, even though there will be a slight increase in prices, We think it's going to be temporary, transient, and it will not lead to the kind of runaway inflation that we saw in the 1980s that everybody's now worried about. And definitely, it will not lead to a change in the monetary policy stance of the Fed, as the Fed has said that it's going to wait before it starts raising the rates. Moving on to the next slide. One reason why the Fed has said that it's going to wait is because it wants the labor market to recover completely. And the labor market is even not back to the pre-pandemic levels. It has been very weak throughout the pandemic. And just as of March, it has started showing signs of improvement. The March employment report was very positive. The economy added 916,000 jobs. That was the fastest pace since August of last year. And at this pace, we can get back to the pre-pandemic level of employment by the end of this year, as there are still 8.4 million who are out of work. The unemployment rate also ticked down to 6%. The White House Council of Economic Advisors, they came out with an employment report based on the official BLS numbers, and that's what I have here on the right. So even though the official unemployment rate is at 6%, if you take into account the labor force dropouts and the misclassification issue that the BLS has been talking about, unemployment rate is actually higher at around 9.1%. That's the dark blue line. Unemployment rate is actually higher at 9%. So that's almost 3 percentage points higher. And even if we look at the male and female unemployment rate, officially the female unemployment rate is now lower than the male unemployment rate. It was actually high throughout the pandemic. So now it's reversed and now it's lower. But if you look at you take into account the labor force participation rate as well as the misclassification, unemployment rate for males and females is roughly the same. This just reflects how many more women have left the labor force entirely during this pandemic. Even if you look at some of the race ethnicity groups, Blacks and Hispanics have been particularly hit hard during the pandemic, and their adjusted unemployment rate is actually still in the double digits. Moving on to the next slide. The worst hit industry, as we all know, has been leisure and hospitality. In fact, this sector alone accounted for almost 36% of the jobs which were lost during the pandemic, and it's still down by 3 million, as you can see here. Even though it's recovered by almost 62%, it's still down by 3 million. However, again, this sector has also started to show improvement. And in fact, in March, it actually had the largest gain. It, I think, gained around 31% of the total jobs gain were in the leisure and hospitality. So that sector is recovering as well. But when we think of leisure and hospitality, now the services sectors which have been impacted, it's mostly renters. A larger share of workers in these sectors are renters, and they, again, have been disproportionately impacted by this recession. And that's also reflected in the higher unemployment rate of renters as compared to owners. You can see here, the chart on the right shows the unemployment rate for the renters at 10% is almost double that of the owners at 5%. However, this data usually comes out with a little bit of a lag. So this is from December. But the trends have sort of remained the same, right? Renters are mostly in the services sector. Moving on to the next slide. So yeah, moving on to the housing markets, the biggest news here has been that the mortgage rates have been rising from their historical lows that they were at all of last year as well as in January of this year. In fact, rates were as low as 2.65% in Jan. And just as of last week, they were at 3.13%. That's almost a 50 basis points increase in a matter of 2 months. However, if you look at history, rates are still very, very low by historical standards. Thinking about the 18% of the 1980s, we're talking about a 3% range right now. So not only historical standards, even if you just compare the rates to Jan of last year, they're still down by almost 60 basis points. And obviously, these low rates have given a big boost to the refinance originations. Total originations hit an all-time high of over 4 trillion in 2020, and refis have been around 2.6 trillion. And these low rates have brought forward a lot of housing demand. It has given a big boost to housing demand. But now we are in a slightly different environment with rates rising. Moving on to the next slide, we actually put out a note a couple of years ago on what happens to housing market indicators during these rising rate periods. So we looked at all the periods when interest rates increased by more than 1 percentage point since 1990. And we found 9 episodes where rates rose more than 1 percentage points. And what we observed is, we also looked at the declining rate periods. And what we observed is that rising rate periods are on an average shorter in duration as compared to the falling rate periods. So you can see the average duration is 13 months, whereas for declining rate periods, it's almost 2 years, 23 months. The average increase in mortgage rates during this period has been 140 bips, that's 1.4%. And during these periods, home sales have declined by around 5%, housing starts have declined 10%, while originations declined 27%, mostly driven by the declining refinances. That's what happens when rates increase. And nominal house prices changed around 8% during these periods, with real house prices increasing around 6%. Moving on to the next slide. But what we are seeing is that despite this increase in rates, housing demand has continued to remain strong. So one metric which we use to measure demand is purchase applications, and that's what we have here on the left. Chart on the left compares the purchase activity, purchase applications for the average of 2017 to 19, 2020 and 2021. And you can see that purchase activity in 2021 had started on a strong note. It declined a little, but it's still very strong compared to 2020. I mean, not only compared to 2020, but even the average of 2017 to 2019 still remains much higher than the levels we've seen over the last few years. And on the right here, I have home sales. Home sales have also continued to remain very strong. Both new and existing homes sales are at levels not seen since 2006. And these home sales are only being constrained by lack of housing supply, which has continued to remain the sore spot for housing. In fact, some estimates suggest that existing home sales would actually have been 20% higher if there were enough homes available for sale. So moving on to the next slide. In addition to the low rates, one other reason why demand has been really strong is demographics. Demographics are very favorable for the housing market right now, especially because of the millennials. In fact, the millennials have surpassed the baby boomers to be the largest generation at 72 million, and they're going to drive the housing demand for many years to come. In fact, what we see is that the millennial share of purchase market increased by almost 5% percentage points in 2020, and they accounted for more than half of the purchase mortgages brought by Freddie Mac at 52%. Moving on to the next slide. What we also observed is that the delayed life stages were no longer deterring the millennials from becoming homeowners in 2020. We had been hearing about how these millennials were really slower than the previous generations in reaching life stages, such as getting married and having kids, because these are the factors which drive you towards homeownership, right? But when we look at the composition of households, we found that a larger share of the younger millennials, almost 20%, they're actually buying homes despite not being married. And of all the recent buyers, 62% were married couples and 9% were unmarried couples. And on the right here, what we found is that 73% of the younger millennials, they bought homes despite not having children, which is higher than 67% for all buyers. And it decreases to 39% when we look at the older millennials from ages 31 to 40. A couple of other characteristics that we wanted to highlight, you can go back to the previous slide, that we wanted to highlight was that the millennials are buying older homes, and they're even preferring detached homes, and they have the highest share of previously owned homes. And we're also seeing that the millennials are buying larger sized homes than ever before. And that's a trend we are observing across because of the pandemic, because of the need for more space, because you're working from home, you're schooling from home. So all of these factors have pushed people away, as Yana had mentioned, away from the dense city centers towards the suburbs and rural areas in search for larger homes. Moving on to the next slide. So as I mentioned, the sore spot for housing continues to remain supply. We've been talking about that, how tight inventory is. And in fact, the number of homes available for sale is at a 4-decade low. If you look at the numbers, it's at around 1.4 million homes available for sale. That's both existing and new homes. And in fact, I've been reading that there are now more real estate agents than number of homes available for sale. That just tells us telling story how tight supply is. If you move on to the next slide, so not only existing homes, they're not being listed, but even if you look at the inventory of new homes, so this chart here shows the homes for sale by stage of construction. So what we observed is that the number of new homes available for sale is also actually lower than what it appears to be. And why is that? Because most of the homes that will come onto the market over the next few months have already been sold. The homes for sale for which construction has either not begun or which have not been completed are at an all-time high of 86%. So the inventory is actually much lower than what it appears to be. Moving on to the next slide. And this tight inventory is also reflected in the higher velocity of home sales. That's at a 2-decade high. What do we mean is that the number of homes which are sold within 3 days of being listed. So if you look at this chart on the left, that shows the percentage of listings which are being sold within 3 days. And 1 in 5 homes are selling within 3 days of being listed. And that's the highest level we've seen since Jan of 2000. And obviously, it's pushing up prices. This tight supply is pushing up prices. And you can see that 1/3 of the homes are actually selling above the list price. This is all from the, like if you compare the data from Jan 2000, you can see that 1/3 of them, that's the highest it's been, the number of homes selling above their list price. And, we have been hearing anecdotal evidence, right? Right here in my neighboring communities, and my friends keep telling me that homes in their communities are selling for 90K to 100K above the list price. So very, very tight supply. Moving on to the next slide. So these demand and supply dynamics have obviously put pressure on house prices, which have been appreciating at very, very strong, at a very strong pace. And as of February, this is the Freddie Mac House Price Index. As of February, the house price appreciation was at 11.5%, very, very strong. And you can see some of the states like Idaho, Utah, Arizona, Maine have been appreciating at a much, much stronger rates than the rest of the country. And Yana had also mentioned that Idaho had witnessed a lot of in-migration. And that's spilling over into the neighboring states as well. And what's surprising here is that states like Hawaii and Nevada, which have been disproportionately impacted by this pandemic because of the nature of this recession, right? Leisure and hospitality, they have been affected. But despite that, even these states have been appreciating at rates of 5%, 12%. So very, very strong appreciation, even in these states. Moving on to the next slide. And what we also saw is that house prices are appreciating across all price tier. So with the fastest appreciation in the lowest price tier, that's where most of the demand is. But the medium and the high price tier are also appreciating at much faster rates than we had seen prior to the pandemic. So that's what I had on the economy and the housing market front. And now I'm going to hand it over to Yana to talk about the forbearance trends.
Thanks, Rama. Can you hear me? Rama, can you hear me?
Yes.
Okay, thanks. So let's delve into the topic of forbearance. Since the beginning of forbearance program, MBA, among several other institutions, have been tracking weekly has been tracking weekly market forbearance activity. What you see in front of you is MBA's weekly reading of their share of mortgage loans in forbearance by agency type and in total. And according to the most recent weekly forbearance and call volume report, there are 4.7% of mortgages that are currently in forbearance, which equates to approximately 2.3 million borrowers or homeowners. The share of loans in forbearances in the latest reading dropped to its lowest level since the beginning of the program, as the economy continued to improve, as Rama just covered in the previous section. One other important point I'd like to bring in to your attention is that Ginnie Mae's share of loan in forbearances, the very light blue line, is 2.5 times larger than GSE share, the dark blue line on this chart, which is certainly reflective of riskier profile that Ginnie Mae loans tend to have. Moving on to the next slide. Let's take a deeper dive into population of forbeared loans. Forbearance programs have certainly been a source of relief for many struggling homeowners. According to Black Knight's data, 6.9 million homeowners entered the program since spring of 2020. And what you see in front of you is a snapshot of this loan population as of February 2021. This chart tells us that 61% or 4.2 million loans have exited forbearance program thus far, out of which 3.7 million are either back to performing on their loans or have paid them off. The data also shows that 6.7% of loans that exited forbearance are now delinquent. That is definitely something for us to think about. While 61% have exited the program, 39% are still remain active in forbearance programs. And according to MBA latest reading, if we look at the mortgage population that remains in forbearance by stage, 13% of those loans are in initial forbearance plan stage, while 82% are in forbearance extension. Furthermore, out of those forbearance extended ones, 32% of borrowers have been in this program for 12 months or more. There's certainly there's a thought that homeowners that have remained in the program thus far may stay in this program for the duration of it, meaning that later this year we anticipate that servicers will have their hands full with large volume of loans rolling out of the programs at once. Page down. Thanks. Here's an interesting perspective into how forbearance impacts supply and prices. According to the recent release of Fed notes, forbearance may have contributed to house price growth by limiting the effect of labor market weakness on for sale housing inventory. So when mortgage assistance like forbearance is unavailable, households experiencing unemployment typically sell their house or face foreclosure if they cannot make their mortgage payments. These forced sales increase the supply of home available in the market and may lower home prices in turn. But forbearance allows liquidity-constrained households to defer mortgage payments and remain in their homes, potentially preventing more housing supply entering the market, which limits the for sale inventory and, as a result, putting upward pressure on home prices. The study calculated that 60% of the year-over-year household growth in the period between April and August and 40% of the year-over-year decline in new listings were due to existence of forbearances. Next slide. Let's move on to the benefit of forbearance and the impact it has on foreclosure levels. Foreclosures are at historic lows, and that is mainly due to forbearance programs. The SDQs, or seriously delinquent loans, which rose in the third quarter of last year, are also declining. We often get asked a question about how many foreclosures did the forbearance program prevented. Our team did some analysis and found that as of first quarter of this year, as many as 370,000 foreclosures were prevented. To come up with this particular number, we looked at what the foreclosures would have been if the trends of 2020 from quarter 1 to quarter 4 continue, and what would have happened if the average foreclosure transition rate of 2009 to 2019 had continued. The difference between these two cohorts given us the number of foreclosures prevented, and that is an astonishing number. It's almost 97% of total foreclosure prevented. So that essentially concludes our presentation. We would like to thank you for your time and be happy to answer any questions you might have.
Yana, Rama, thank you so much. It was quite the plethora of great content just between kind of the economic trends, the forbearance trends, as well as how the COVID and economic recovery as part of that are going to affect some of these metrics. So, no, I've got some questions lined up here, but want to remind our attendees as well. Any questions that you have for our team from Freddie Mac on the line here, feel free to drop them either the chat or Q&A functions, and I'll be happy to verbalize those on your behalf. But let me jump into a few that I've got here already. First one, since inventory, obviously a very pressing issue right now, through Freddie Mac's findings, are seeing any correlation between the population of states who have gotten at least one vaccine dose at a higher percentage, or between those where more homes are starting to hit the market, I guess, in these areas, or if that was taken at all into the the findings for this first quarter review.
Rama, you want to address this, or you want me to take it?
Yeah, no. So, obviously the expectation is that there will be more homes coming onto the market. There are many, especially elderly folks who were waiting for the vaccine to list their homes for sale. So they were holding back on. So the expectation is that the inventory might pick up when we see more ramp up in the vaccine distribution. But I guess, they're still not completely confident. So this data is as of February. So, that's when things started to ramp up. March was when we saw a huge pickup in the vaccine distribution. So we are definitely hopeful that there will be more listings this year. That's why we have forecast of home sales still going strong this year, just because we expect that there will be more listings. People will go out and list their homes.
Absolutely.
Yeah, I would second that. Yeah, I think it's a bit too early. We might want to wait a few moments.
I think I also saw some research that said that almost 50% of homes that were supposed to be listed have not been listed due to homeowners being cautious and concerned about the pandemic and having people walk through their homes. So I imagine by the time the midsummer comes and more people are vaccinated, we may start seeing a surge in homes being listed.
Well, and it would make a lot of sense too, just, thinking to that scenario this time last year and people that wanted to put their homes in the marketplace in the 2020 spring buying market, who, instantly would have pulled back just out of fears of, to your point, Katie, having people come into their homes for viewings and listings, or just unsure about how to get the transaction itself done. Not to mention, through the stimulus packages, people, with extra time on their hands, looking inward to different ways to enhance the value of their home through different renovation projects, probably eager to see that maybe additional equity be realized and hitting the market this summer.
Right. And if you think about it, that potentially is going to be an inflection point where rates may go up to around 3.5 or slightly higher. Home prices are experiencing, let's say, around 10 to 15% increase. And the pandemic is starting to slow and infections are starting to slow. If you put all those three together at the same time, you should see a sudden surge where everyone's trying to take advantage of the fact that they can sell their home for a lot higher than they ever had expected, combined with, low rates. So there's going to be that inflection point.
I know our members would be happy to see that, just with the recent fall off in application rates. It's really the beginning of March here.
Right, exactly. Yeah, we've seen some fall off, but again, it's that whole inventory issue, not so much the demand issue. Yeah.
In fact, just to add to that, to the inventory, so Jan and Feb of this year, there are some estimates which suggest that listings were down by almost 207,000. Mainly driven by probably the severe winter weather that we had across some of the southern states as well. So, and that's compared to the average over the last 4 years. So, in addition to the pandemic, we had the winter weather. So hopefully, spring things will start picking up.
Absolutely. Thank you, Rama. Another question here, I think kind of based off of the labor market recovery metrics, just a question from that slide, if it factored in the percentage of the population not re-entering the labor force during the pandemic.
So yeah, I mean, as I was mentioning, more women have left the labor force. In fact, the female unemployment rate actually jumped up quite a bit. And if you see, since after the financial crisis, up till the beginning of March of last year, it was more women who were driving the labor force. And it's because of them that unemployment rate had actually hit a 50-year low of 3.5% in February of last year. So that was, it was being said that it was mostly because of women entering the labor force. And now when the pandemic hit, many left the labor force. They stopped working. They stopped looking for work to take care of their kids who were at home all the time, to take care of, the elderly or those who were suffering, who were not well. So all of these factors have pushed many more women out of the labor force. And that's one concern that all the economists have, even in terms of the future recovery of the labor market. So until it's completely recovered, even the Fed is going to wait before it starts raising the rates, even if it sees the inflation pick up. So that's how the two are tied, so the labor market recovery is very important there.
That's a great point, Rema. It should be really interesting to see too, especially towards the back portion of 2021, as hopefully schools are able to start a year in the fall on kind of more normal conditions, as well as vaccinations continuing to increase across the country, particularly towards our elderly or pre-existing condition prone folks that, we're taking care of within our family structures, that it does open up, the opportunity, especially since really the female population tends to bear a lot of that burden for caring for the family, to be kind of freed up to re-enter the labor force. I know it'd be a welcome sight to see in those late year employment figures if it reflects that much.
Tom, I think you make a great point along the facts that schools being closed and somebody having to take care of the the family, right? Even if it's the elderly or even young kids. So yeah, you're exactly right. I think by fall, hopefully everybody's starting to go back to school and allowing the caretakers to hopefully jump back into the workforce.
Absolutely. No, it's great points across the board. And I know we've got a couple of minutes left here. So last call for any questions that come in from our attendees to be able to verbalize out on your behalf. The other question I had here was, is it the expectation of Freddie Mac that the weekly purchase applications will continue to kind of follow a similar trend line as I think you shared in one of the slides with 2020 metrics, but maybe minus the steep drop off that we saw in March through May of last year during the initial pandemic lockdown?
Yeah, we do expect housing market to remain strong this year as well. So we are hoping that apps would pick up, and it's minor blip. Again, the demand has been brought forward because of the low rates. So, when rates start rising, people want to enter the market. They're like, oh my God, rates might increase further. Let me jump in right now. So that is going to, push the housing demand. It's going to maintain the housing demand. It's going to be strong this year as well, we think.
Okay. Excellent. Another question I had in Freddie Mac's findings as it relates to new home inventory being so low, was the findings that a big contributing factor related to the cost of construction and construction related supplies kind of driving that factor for, I'm sure, especially towards affordable new housing?
Right. Yeah, construction of homes, if you compare it by decade, 2010s was almost half it had been over all the previous years, over all the decades. Construction, whether you look at it per person construction or just the absolute numbers, have been very, very low. And there are various factors which have prevented construction from picking up. You had labor shortages, you have raw material shortages and costs, land use, regulations, zoning restrictions. So all of these factors prevented more supply from coming onto the market. Even land developers, they went bankrupt after the financial crisis. They've not come back. So in addition to all of that, during this pandemic, lumber prices increased 150%. So that is really adding to the cost. And there are many builders who are, struggling with these higher material costs because they have to pass it on to the consumers. And that's, of course, affecting the affordable supply. But not only lumber, there's a lot of supply bottlenecks, which are preventing more, supply from coming onto the market.
Yeah, if I may add, I think, Brahma, isn't it true that even before the pandemic, we already had a housing shortage that was, close to 1.5 million or more?
Yeah, in fact, we had estimated in 2018, it was 2.5 million units shortage. Yeah, the supply had been a problem since after the previous financial crisis. And the tariffs that were imposed on the raw materials, that added to the cost. But now it's just been exacerbated because of the supply bottlenecks because of the pandemic, so as well.
Mm-hmm.
So all of those.
Just to add to this, one of my old colleagues from a builder company was complaining that they don't have materials to last them for the next couple of months. So they constantly run out of the materials, and because of the bottlenecks, because of all the exports that they get, that has been interrupted from China, the supply, cutoffs, and they're constantly running out of the materials. That's been a challenge for them to build and deliver units on time. So
supply chain issue.
yeah, as well, yeah, and
Mm-hmm.
as well that drives the prices up too.
Excellent. And then last question I've got here, just first a comment, great metrics as it relates to charting the inflation figures over recent years. Looking forward, is it Freddie Mac's expectation that the economic recovery will push inflation above finally kind of that 2% threshold that we all have been keeping an eye on for multiple years now?
Yeah, so there is the expectation that it will increase above the 2% target. But one is Fed has changed its monetary policy stance in August of last year. It said that even if inflation goes up above 2%, it's going to wait and watch because inflation has been so low over the years. And the moment it starts picking up, it jumps in to raise the rate. So it's going to hold off on doing that. And again, as I said, most of it is going to be transitory and temporary, with all these supply bottleneck and issues. And also the demand, when the economies open up and people just jump in to buy all of these stuff, to take those vacations. So that might push up prices, but then that we think will taper off and it will go down. So we might see a temporary pickup in inflation to the 2% target of the Fed. So the CPI did go up to 2.6%, but the Fed target it measures the PCE inflation. So that's been still around 1.5, 1.6. So it might go above the 2% range, but again, we think that it'll go back down again by the end of the year. So,
I think one thing I would add is that I agree with Rama. I think there's a strong pent-up demand for supplies, for travel, entertainment, all of that. In fact, I think I heard that the 2022 cruise line bookings are already filled. So you can see there's a tremendous amount of pent-up demand, but I think the true bogey is going to be, what is the employment situation going to be, right? There's so many people that are still unemployed, not even looking for work because, hundreds of thousands of businesses have shuttered that are never coming back. These are things that are also still looming, right? So while there's pent-up demand and there may be some higher inflation in the short term, what's more important is what can be sustainable, right? And the only thing that can sustainably keep inflation up is going to be higher income, significant job growth. So if we don't have those coming into play immediately, I would say there'll be one of these spikes and then things leveling off. Again, that's not a Freddie Mac opinion. That's a more KT Thomas opinion. Just if you think about it macroeconomically.
Well, excellent, Katie. I appreciate the feedback and really, Yana, Rama, Katie, excellent discussion. So many great insights. I'm excited to share out the findings back with our attendees and registrants from today. And again, last reminder, registration information for the third part of our series with Freddie Mac on deconstructing the millennial generation on Wednesday, May the 12th is in the chat. And we'll also include that information in our follow-up correspondence from today's discussion tomorrow. But again, just want to thank each of the three of you for your time and your insights today. I've really enjoyed this discussion, and this has been a very insightful series for me to be a part of as well.
Thank you very much, Tom.
Thank
It's
you.
been a pleasure for us.
Absolutely.
Thanks.
Well, thanks, and have a great day, everybody. Appreciate it again. Talk to you soon.
Thank you.